I wrote around 1,000 reports, deep dive analysis reports on publicly traded companies. I basically analyzed all the different investing legends, as it were. I analyzed all their strategies, and I aim to take the best of each strategy and use them together. Sometimes you need to be a contrarian and you need to understand, okay, this is the consensus. There is a contrarian approach and you have to be right. So you have to have an insight which others don't.
Welcome to the show. This is Mariusz Konieczny. I am chatting with Ben from Ben Motivation to Invest. Ben, thank you very much for joining me.
Yeah, hey, great to be here, Mariusz.
Ben, you have quite a resume, quite experience. So let's get into this. You run a YouTube channel, Ben Motivation to Invest.
Yeah.
You are a former Microsoft employee.
Yeah.
You've done a lot in the investing space. So take a few moments, introduce yourself, please.
Yeah. So you're right. I run Motivation to Invest YouTube channel. Ran that since 2020. We cover mainly growth at a reasonable price. So think of it as a combination of growth stocks and value stocks, and somewhere in the middle, which I can get into after. And in terms of my background's very heavy on the tech side. So I actually started my career designing IT networks. Then I went into consulting. Then I ran a digital agency, digital marketing, for around 6 years until acquisition. And then I've worked for a few very large corporates doing digital strategy mainly. But then I've also used to work with a lot of hedge fund clients. And I wrote around 1,000 reports, deep dive analysis reports on publicly traded companies, variety of industries, but mainly I focused on tech and fintech. And I covered a lot of companies such as Nvidia, which I'll get into later. I covered them back in 2021. And some of my reports are still online from those early days on Yahoo Finance. They're still online on Seeking Alpha and other areas from those days.
And so when you wrote reports for hedge funds,
Mhm.
you were hired on an individual basis to research individual stocks for them?
Yes. It was basically contract work because I was working with them on digital strategy. And then also I had this passion for investing. I read 600 books on investing, on finance. I did my MBA in corporate finance and company valuation. And so I had a lot of passion and drive to understand and beat the market like many people do. And I caught the bug when I read a lot of books by Warren Buffett. I read Peter Lynch, One Up on Wall Street, and those books just really lit a fire inside me to really get into investing into the stock game. I started writing initially for different websites, Guru Focus, Seeking Alpha, my own platforms, and then a few hedge funds started to see these reports, and then they asked me for reports on other companies, and then it snowballed from there, and then I ended up writing 1,000 different companies. One notable report I did a while back was on, it was more of a controversial report where I said, should Amazon spin off AWS? And it was a deep dive into, okay, if Amazon broke up its business into a sum of parts, what would be the valuation? And from that report, it looked like it would unlock a lot of shareholder value. That report was picked up by a hedge fund in Australia, ran by a guy who's basically a billionaire, and he's known as the Australian Warren Buffett. And then his report, he saw that report. I had a call with one of his analysts, and then that was just one of many situations where I ended up doing analysis reports for these funds.
Do you still write for Seeking Alpha and Guru Focus or any other places?
Yeah, not anymore. Not anymore. I've been paused from that since, I'd say end of 2023. And it was mainly, I timed it well, I think, with AI, the rise of AI. Now you have a lot of reports that are written by AI, and it's hard to tell the difference. But I still do analysis, and I have a community on Motivation to Invest where I post my analysis to my community. And I can do that, both in video format or in a report style. But some of the hedge fund reports, they're a lot more detailed, as it were. Whereas, as you know, with YouTube and communities, you want to make it maybe more concise for people. So I vary the formats.
But I think because you see in the 2010, 2012, I think there was a lot of, blogs, articles seeking alpha,
Yeah.
because I did write a few articles for them too. But I feel
Mhm.
like now it's shifted more for like, video content, YouTube. Do you
Yes.
feel that too?
Yes, so there is a shift based on video content, yes, in terms of people engage more with video. And as you know, with the rise of short form video platforms, TikTok, even Instagram Reels, people's attention spans are dwindling and they want to see the quick content, which is good if you can condense down complex topics into small places, but still long form content does have a place for those people who want to go that little bit deeper or a lot deeper in certain cases. So what I used to do is I would write a deep dive report covering everything from the business model, from the competitive landscape, from the financials, from the margins, from the forecasts, then into a advanced discounted cash flow valuation model with a Monte Carlo simulation with each different scenario for the company over the next 10 years. And then what I would do is from that report, I would translate that into a video and I would do the key highlights in a 10-minute video
But how long have you been making YouTube content?
since 2020. So I actually started right at the start of COVID, 2020, and that was the timing of that was perfect because I was running a digital agency at the time. A lot of our clients were on pause because they were in the travel industry. And so we used to actually grow YouTube channels, work on YouTube strategy for businesses. So it was a perfect time where I had more time personally. I could dedicate more time. And that's when I read, okay, I thought, okay, I've got time now. I read 600 books on investing. And then I started making videos and I ended up making probably 800 videos on investing and stocks, usually in the individual analysis.
Now, you mentioned that your investing style was influenced by Warren Buffett and
Yes.
Peter Lynch, but they're quite different because Warren Buffett, you know, focuses more on the free cash flow
Yep.
companies that are already returning money to investors, where Peter
Hmm.
Lynch is a bit early in the investment cycle.
Yep.
So, like, how did this develop your style?
Yeah.
Looking at those
Yeah.
two individuals that are quite different.
Yeah. No, that's a really great question, Mario. So I basically analyzed all the different investing legends, as it were. I analyzed Warren Buffett, Charlie Munger, Peter Lynch, Joel Greenblatt, almost everyone, David Einhorn, Howard Marks. I analyzed all these people. I analyzed all their strategies. And what I discovered was quite a few commonalities across the different strategies, obviously some differences. And I aim to take the best of each strategy and use them together. So, correct, you're right what you're saying in terms of Warren Buffett's style. He's focused very on free cash flowing businesses. Obviously, Berkshire Hathaway is so large now, he focuses on larger scale investments. But he has some fundamental core principles which are super valuable in any strategy. So, for example, understanding the intrinsic value of a company, buying it with a margin of safety 20% below that intrinsic value. So those are some of the core tenets. Ability to understand Mr. Market, as it were, in the cycles of the market, and understand, okay, is the market now greedy and I should be selling into that greed, or are we in a fearful state where I need to actually be buying? So one of his obviously famous quotes is, be greedy when others are fearful and fearful when others are greedy, which is really a contrarian approach. And so even in 2020, that kind of approach informed my strategy massively. And when oil prices went negative, for example, and people were saying the general consensus what was that, okay, oil is over. It was all EVs. It was all future of tech, clean energy. And I understand that industry and there's still a place for that. But there was a consensus at the time, travel has stopped, oil is over, investing into oil is a bad idea. I did a video basically saying, no, I think it's a contrarian point to invest into oil at that time. And a lot of the stocks I invested into, Shell, Chevron, etc., they all tripled within a few months once obviously COVID COVID finished. So really, the lesson of that is sometimes you need to be a contrarian and you need to understand, okay, this is the consensus. There is a contrarian approach and you have to be right. So you have to have an insight which others don't.
Also, in the early part of my investing, value investing was hot. Everybody was talking about Warren Buffett, Monish Pabrai, and now I feel like nobody cares. Value investing is like out of style. You're not cool. You're not cool. It used to be cool to be a value investor. It's not cool anymore. And I saw your video you talked about, is value investing dead? Please talk to us about this.
Marius, another fantastic question. So you're right. The consensus now, value investing is boring, it's dead, people shouldn't do it, it's crazy. That is the consensus right now. However, if you look at history and you look at, and I did a full analysis of looking at value over the past decades, and you can see there is still an alpha with buying value in the majority of decades past. Over the past 5 to 10 years, it's not been as significant as it used to be. And even billionaire investor David Einhorn of Greenlight Capital, who I've covered a lot on my channel recently, he is a true value investor and he calls himself a dying breed. And he actually is still convinced that the market is broken. He's convinced that buying a company that's worth, let's say, $10 per share, buying it at $5, waiting for it to go up to 10, he thinks the market is broken and that value investors may not be rewarded. So this is the challenge, the tension. However, that guy is also the guy who predicted the 2008 financial crisis, when everybody was saying housing prices can only go up. Things can keep going to the moon. Things can keep going up. He predicted the opposite again. So what that shows you is value investing is, you could call it the common sense approach to investing. It's understanding the value of things and buying it based on that value. Now, you could talk about crypto, and it's very hard to value crypto. You could talk about real estate, which is a bit easier to value. But really, I think that the best way I like to work with the concept of value investing is, it's about understanding the value of the company and then having complete self-awareness to say, okay, I understand the company is trading at this, its valuation is this. If I'm happy to pay over that valuation because I'm expecting growth, then I'm fully self-aware of that. I'm not buying a company that is trading at $100 per share for $1,000 per share and expecting that to happen. So it really takes self-awareness to be a good value investor. But if the whole market crashed tomorrow, value investors would be in a better place, let's say, than somebody who's just chasing momentum.
Also, over the years, I think value investing is misunderstood, because value investing is not about low PE ratios, low multiples. The value, like I can value a car and it doesn't generate any income, right? And just because something is trading for, or has negative net income, or is trading for 1,000 times PE, doesn't mean it's overvalued. You can have a company in a startup stage with a big addressable market, a big solution to the market, and it doesn't show much revenues, but it could still be undervalued. And I feel that people miss that in the value investing community.
100%, Marius. So that is a very great insight, which you get, I get, but not everybody always gets that. Some people do, and they think, okay, some traditional value investors, you might call them, they will not buy a stock that's got a PE of over 10. They'll say, okay, price of earning is over 10. I am not buying it. I am super rigid. However, if you understand true valuation, which is really based upon a variety of factors, it's a lot more complex. And really, if you look at, I like to use discounted cash flow models, but even with those, I use a concept which was taught by Ashwath Damodaran, who's the professor of valuation at NYU. Yeah, he's like the leading guy.
I used his book when I was in college, the valuation book. we
Yes.
use it.
So his model is the style I use. So what he does is he translates narratives to numbers or numbers to narratives. So if a person says, okay, I expect Nvidia's margins to increase by 20, 30% over the next 5 years. That's one assumption. Okay, what's that based upon? And he has specific points to base that on. And so that's the way I do valuation, is in terms of the valuation model, which I have, and I give the valuation model to my community for each stock, and then I look at the different narratives that drive the valuation. And yeah, it's not easy to value. And actually, there's a quantitative side, which is all the finances, the numbers. And the challenge is now all that data is already priced into the stock because everybody has that. So this is where it goes back to Peter Lynch, as I was saying earlier. Peter Lynch is an interesting character, and he used to do what's called the scuttlebutt method as well, where he would actually speak to management of companies, understand them, speak to employees, speak to customers to understand a product, a unique insight. And that style is still not done by majority of professional analysts. They're in an office in New York. They're analyzing the balance sheet and the income statements, but everybody's doing that. They're not going and speaking to a customer of a
Well,
hot new
I mean
product.
that's 3 inches in front of your face. Everybody can see that
Yes,
financials.
exactly.
But what you're saying is
Yes.
picking up the phone, making a trip to see the CEO.
Yep.
You can uncover things that are not visible to everybody else.
Yes, exactly. You can uncover unique insights which are not priced into the market. And I think really the essence of beating the market and generating alpha is identifying mispricings. So how can you identify mispricings? Well, by definition, you have to find out information which others don't have. And it could be alternative data, it could be an insight, it could be even management. And I remember a long time ago, must have been maybe 10, 15 years ago. I was speaking to a good friend of mine who was also into investing a lot. And he wasn't really a finance guy, but he was very into the people, into management, into understanding that. And I remember seeing a biography of Elon Musk. And this was when Elon Musk, he wasn't as popular as he is now and the richest man in the world. He was kind of still a niche character, like, oh, you've got Elon Musk. Yeah, he's an interesting person. I remember seeing a biography of Elon Musk. I was like, oh, that's interesting. You're reading a biography of Elon Musk, and he was talking about how amazing he is and this vision and Tesla. And I remember at the time I thought, okay, interesting. But then Tesla at the time was creating a new car company, which everybody thought was going to fail because nobody had created basically a new car company in, I think, over 100 years that had actually been successful. So, but what he saw, and I actually interviewed him on my channel back in 2020, was that Elon Musk was an incredible entrepreneur. And how can you value that entrepreneur? Well, it's clear his value now is worth billions and billions of rich man on the planet. But understanding that Elon Musk is a special person, yes, you might not like him, you might not like everything he says, but his results in terms of SpaceX, Tesla, Neuralink, Twitter, now X,
He
incredible.
creates value for society.
He creates value.
value for society, and
Yeah.
and you know, and disrupts industries. There's
Yes.
who care. I mean, yeah, you can disagree
Yes.
with his political personal thing, but you cannot disagree with this.
Yes, 100%. And that's why it's important to understand, yeah, the people who are running a business. And if you ever do any startup or VC investing, I work with a lot of VCs in the venture capital world as well. They all about bets on the people, especially at the early stage. And so if you could make a bet on Elon Musk and get a percentage of what he's going to build over the next decade, and you could do that 10 years ago, 15 years ago, that's worth billions of dollars. And that would not show up in any finance sheet at all. The only inclination is obviously, he did co-found PayPal before, so there's that obvious, but a lot of people were part of that PayPal mafia. They also were successful, but doesn't mean he was going to create something which would be one of the most valuable companies on the planet. So the trick is to combine this quantitative financials with the qualitative, the management, and also identifying bad management in terms of how they act, how they are as people, because they're really the people who are driving the organization.
Talk about some of your wins in the market, and maybe some of your losses, because we all have them.
Yeah. So I can go back to let's start with Nvidia, for example. And I won't talk about Nvidia now, because now it's all priced in. Everybody knows it's amazing. I'll talk about Nvidia and how people thought of Nvidia back in 2022. And I might even have, let me see if I have my report here. I'll just flash this report up really quickly just to show you on the screen if I share this really quickly. This is just to show you just very quickly. So this report was written March the 2nd, 2022. Deep Tech Insights, which is there's me there. This is my basically where I was writing from. And I was covering Nvidia here, $22 per share. It is now at $164 per share. So I think it's 1,600% return. Pretty significant. Now, I'm not going to sit back and say, okay, I'm a genius and I predicted that Nvidia is going to be the AI backbone of the world. That wasn't really the business case back then. However, what I did see at that time was there was a cyclical pullback in the gaming industry. They sold GPUs. They were the market leader in GPUs. There was a cyclical pullback, and anyone who studies the chip industry will know it's a cyclical industry. You get huge buying times and huge times where the pricing of these products, it could be GPUs, it could be processors, it could be hard drives. It's cyclical. So that was really the thesis back then. AI was a part of it, but it wasn't everything. They also did a lot in the metaverse. They built digital twins, but it was still a strong part. So that was one of my wins back then. Admittedly, I didn't hold it all the way until now. I've sold it when I've got maybe a 500% return, which I think was quite reasonable. One thing I didn't do, and you talked about mistakes, one of the biggest mistakes I've made when I've been investing is position sizing. And I think this is what we all struggle with. And I think it's probably the hardest thing for any investor. Because if you truly have conviction and you truly know a stock is going to go up and you truly have an insight that nobody else has, then as Charlie Munger would say, you should load up the truck. And so with Nvidia in this case, I had a position, but it wasn't as big as I would have liked it. And what I should have done was actually put a much larger position. It still could have been reasonable for me. It wouldn't have broken the bank, as it were, in terms of my portfolio, but that would have made me a multimillionaire just off that one investment. So that's what I've learned is sometimes it's good to sit back, analyze deeply, and again, this goes back to Warren
and do nothing.
Yeah, this goes back to Warren Buffett's strategy. Yeah, back to Warren Buffett's strategy. So Warren Buffett's strategy is he waits for a pitch to come in his sweet spot and then invests. And so sitting back, as you would say, sitting back, wait, do that deep analysis. And if you truly have this insight, then load up the truck. Obviously, still make sure you're personally protected financially. But if you have a portfolio and you're happy to take that risk, then it's good to have a good position size. And it could go into diversification and talk about diversification. But usually, as Ray Dalio said, the benefit of diversification is only gained up to, I believe, 10 to 12 stocks. After that, the benefit dwindles in terms of how many you need in a portfolio.
Yeah, okay. It is tough because if you have too many positions, one position is not going to change your life, right? But then if you have that big conviction, like even if you look at Elon Musk, I mean, two things made him the richest person in the world. But how many of Elon Musk wannabes are out there that we never hear about that had that conviction and lost and went to zero? So it's like what's the right thing, right? It's tough. It's tough. But so with that being said, my final question is: do you have any final thoughts to my viewers? Where people can find you if they want to learn more from you.
Yes, so feel free to head over to Motivation to Invest YouTube channel. We're also launching a stock investing platform soon, and maybe we'll partner with Marius in this as well. I'll chat to him after this meeting. We're launching that soon, and we'll be tracking all the hedge funds, and we'll be looking for these insights and trying to gain alpha in the market. And we also have a community. So yeah, feel free to check out the channel, and we've got a wait list for the platform and also links to the community.
All right. Well, thank you for doing this.
Yeah, thank you, Marius.